Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important pieces of news that move the markets. I am your host Anurag Bansal. Today we'll be talking about 4 very interesting stories. First, how SEBI is working towards making bonds more accessible to retail investors. Second, how the Indian job market has been giving us mixed signals about its growth. Third, we'll talk about the credit to deposit ratio in India. And finally, fourth, we'll take a look at private markets and look at how VCs are investing in India. So let's begin with the first story. Look, yesterday SEBI issued a new circular. This circular gave bond issuers the option of issuing bonds with a face value of Rs 10,000. Now, in case you're wondering why you should even be caring about this in the first place, let me simplify things for you a little bit. The face value of a bond is the final value after it matures. The price of a bond is pegged to its face value. The minimum possible face value of a bond earlier used to be 10 lakh rupees, which is a couple of years ago, but now it has been reduced to just 10,000 rupees. Why, you might ask? Look, a big problem for Indian corporate bond markets is that it has almost zero retail participation. The entire market is made up of banks, institutional investors, HNIs, and mutual funds. There are many reasons retail investors are absent from corporate bonds, but to keep things simple, here are a few of them. First, bonds are extremely tricky to understand. See, before investing in them, an investor needs to understand a few things like yield duration, credit ratings, the impact of interest rates, and a lot of other things as well. Now, most regular investors like you and I don't really understand these things. Second, almost all the bonds are issued through something that is called a private placement. In a private placement, a company only sells bond to a selected group of investors rather than offering them to the entire public. Why do they do this? That is because they are simply easier than public offerings. There is less paperwork involved and you don't need to be a public limited company for doing this. But private placements are mainly only meant for large investors. Retail investors aren't really allowed to invest in them. Third, the bonds issued through private placements used to have face value of Rs 10 lakhs or more until 2022. So even if someone wanted to sell these bonds to the public, they would be way out of the reach of most retail investors. So to address the third issue, in 2022, SEBI tried an experiment. It let companies issue corporate bonds through private placement with a lower face value, which is 1 lakh rupees instead of the previous 10 lakh rupees. Now this was a great move in theory, but realistically 1 lakh rupees was still too high and bonds still remained unaffordable for most retail investors in India. But still, the move looked very promising. So the SEBI decided to revise this even further. In December 2023, SEBI issued a consultation paper and they floated the idea of another drop in face value of bonds. This time, they decided to drop it to 10,000 rupees. And yesterday, SEBI made this official through a circular. Now what does this mean? See, this basically allows companies to issue bonds with a face value of just 10,000 rupees through private placement. SEBI hopes that if the original buyers sell their bonds after a placement, these might reach retail investors going forward. By the way, there are also other ways in which corporate bonds have been made more attractive for retail investors. Debt mutual funds used to have something called the indexation benefit. This made them more attractive than corporate bonds for tax purposes. That benefit, however, was removed in 2023 and it brought bonds very close to debt mutual funds when it comes to their attractiveness for retail investors. But either way, there is still a key challenge that the corporate bonds market faces. Today, the safest companies, which are rated AAA, do not really issue bonds. They instead borrow money from banks. It is only the company who don't have this option that tap into the bond markets. Typically, these are NBFCs with low credit ratings, and that means their bonds are very risky and still unsuitable for retail investors. Now, the hope here is that the SEBI and the government will soon find a way to make it more attractive for large AAA rated companies and PSU companies to issue bonds. Now, moving on to the next story, we'll talk about the job market. Every month, Naukri.com, which is India's largest job portal, releases a report called JobSpeak. In this report, they talk about trends in the job market and how things are really moving in general. In June's edition, they shared some really interesting insights. Overall, in June, India saw a surprise 8% reduction in white-collar jobs as compared to the month of May. Now, according to Naukri.com, hiring in June typically remains flat. So an 8% drop was a little surprising. But this drop in overall numbers also comes with some bit of positive news. See, while all metro cities saw a decline in hiring, emerging cities, especially in and around Gujarat, saw a massive spike. This is great news because it shows that India's workforce is becoming more evenly distributed across the country. India's overdependence on cities like Bangalore, Mumbai, Delhi, etc. is reducing. By the way, this also means less traffic jams. But the reduction in cities like Bangalore, Mumbai, Delhi could also be due to a general slowdown in the IT sector. According to TeamLease, which is another leading job portal, IT services company would earlier maintain a bench strength of about 20 to 30% of their entire workforce. But now this has slowly started to reduce to 10%. And this is happening because companies are now focusing on upskilling and training their bench employees for redeployment. And this could also explain why IT hiring has slowed down a fair bit. However, another thought is that the slowdown could also be because IT companies want to wait until the US election results in November this year. This is very important for them because India exports over $200 billion worth of IT products every year, and policies abroad heavily impact IT businesses sitting here in India. Now, another interesting point in this report is that companies aren't very interested in hiring people with less experience as of late. Employees with 4 to 7 years of work experience saw 13% less hiring in June 2024 as compared to June 2023. On the other hand, the exact opposite has happened for employees with over 16 years of experience. They saw a 13% jump in hiring. Now, this is probably why there is so much news about bad campus placements lately. Companies seem to be okay with hiring less people, but they want to hire more experienced professionals who can join and start contributing to the company immediately. This might also be a symptom of our employability crisis. Many Indians, despite having a formal education, are not really employable. This means they don't really have the ability to take up skilled work because the education they got was of poor quality. As a result, they find it hard to get jobs. Why this is important is because young Indians make up 83% of the unemployed population. As companies shut their doors on lesser qualified candidates, many people are at the risk of getting stuck in a perpetual cycle of unemployment. Basically, they're unable to get any experience because they don't have any experience. By the way, since we spoke about EdTech yesterday in some length, here is an update. Hiring in the education sector has also been down. This should not be too surprising though. EdTechs have been struggling quite a bit off late and they have laid off quite a few people. Now moving on to the next story, let's talk about India's credit to deposit growth. Who puts money in the bank anymore? What do you really use your money for? You probably pay rent, taxes, your bills, buy groceries, shop, and probably go out in general, right? But what about the rest of your money, or your savings in other words? Well, they make their way all through the financial system. All sorts of entities, banks, mutual funds, listed companies, pension funds, insurers, etc. are always in an intense competition for your money. Let me tell you how banks are feeling the heat of the competition right now. Over the last few years, there has been a big boom in India's capital markets. They have consistently delivered great returns and drawdowns have been few. Now because of this, many people who would have otherwise put their money in their savings bank account are now moving it to the capital markets. And this is becoming a problem for banks. Because the RBI has kept the repo rate high, money is becoming expensive for banks. The banking industry itself is quite competitive. And on top of that, capital markets are slowly eating away people's savings as well. Now because of this, banks have started to offer an average interest of 6.9% to people who are making fixed deposits. This, by the way, is the highest number we have seen in quite some time. At the same time, they're also going out and giving loans at roughly the same rate as before of 9.8%. This means the money that the banks themselves make has fallen to 2.9%. A quarter of their margin has disappeared over the last 2 years alone. Now even this is not helping though. Banks still are not able to grow their deposits as fast as their lending. The ratio between the two, which is their loan deposit ratio, has jumped up in recent times. There is very little that the banks can offer which is as attractive as the current bull run in the stock markets. All of this has really worried the RBI. The RBI governor was recently reported to have also raised concerns about the growing loan deposit ratios with top bank executives, and he urged them to address the growing gap. Now of course that's easier said than done when you're up against the entire financial system of the country. Now that was a bit about the capital markets. Let's move on and understand what's happening in the private markets. You remember how last year, all that we heard or read about was the bad news of layoffs and the funding winter? The good news now is that things are improving this year. According to Venture Intelligence, in the first half of 2024, Indian startups raised about $5.5 billion from VCs. This has increased by about 15% as compared to the same time last year. Now, even though this is significantly low as compared to 2022 levels when Indian startups raised more than $10 billion in just the first half, this is a movement in the positive direction. Now, a big chunk of the investments this year has gone towards fintech startups. Now, interestingly, The Ken recently wrote about how unsecured lending is also generating profits as of late. While the common narrative has usually showcased otherwise, around 24 out of the 29 unsecured lenders that The Ken tracked turned out to be profitable. Now, VCs seem to have caught on to this trend. A significant portion of the total VC funds this year were given to fintech startups. And it was no surprise that the money primarily went towards lending startups. This includes both secured and unsecured. Now, fintech was followed by e-commerce, where Meesho and Zepto raised very big checks. Moving on, talking more about where the money has gone, most of it has been routed to late-stage startups. The big change, however, that we've seen this year is that capital is not really easily available anymore. It's not quite like how it used to be in the 2020 to 2022 period. VCs aren't really fighting for deals anymore, and companies that have raised money this year are either already profitable or have shown their investors a meaningful path to profitability. Burning piles of money in the hope of growing is not an idea that VCs seem to be too keen on investing into right now. Also, it is very interesting to note that around 75% of the total funds that startups raised this year have been from foreign investors. Former CEO of Niti Aayog, Amitabh Kant, recently shared some very interesting thoughts on this on X. I quote, "We need to increase domestic sources of capital for startups. Currently, foreign funding accounts for 75% of the funds flowing into Indian startups. A large pool of fund exists domestically and a portion should be channelized towards startups. Large institutions like insurance companies and pension funds must set aside a portion of investable surpluses to invest into startups. Family businesses and family offices can take on the role of angel investors or provide seed funding. Increased Indian funding must drive India's startup movement. With India's innovation and ingenuity, the key lies in betting on our own selves." Well, that's all the news and information I have for you today. I hope you found value in this. I'll see you in the next episode. Take care.